3 to 5%. So now let's come to the Ask Weekend Investing round number 42. Past 41 rounds links are there in the description below. 712 queries I've tried to answer. And the next one is from Shabazz. Is there a possibility for gold to go up alongside equities? In what scenarios can we see that happen? Is there a systemic way to dynamically adjust our gold exposure from time to time? So very good questions, Shabazz. Uh, Gold has had a history of doing very well when equities are not doing well. So that is certainly a correlation that we have tracked, and it has a almost 100% correlation of inverse correlation. Now, whenever equities are doing well, gold overall on average has done well, although gold has in Indian rupee terms has not always done well when equities are going up. It is supposed to be a hedge to equities. So whenever equities are doing very well, I mean, gold need not be performing at that point of time. So in terms of role of gold, it fulfills itself fully when equities are down. But as a long-term investment, you have seen gold perform 11.5 to 12%, which is very close to where Nifty is performing. In the second question of systematic way of dynamically adjusting gold exposure, so you could perhaps look at a periodic readjustment of your portfolio. Let's say you are at 75-25, for instance, 75% equity and 25% gold. Every year, perhaps maybe you can rebalance your portfolio. If gold has gone from 25 to 30, you bring it back to 25, or whatever be that number that you are comfortable with. You can systematically adjust your allocations to that point. If let's say in a year where equity has come down dramatically from 75 to 60 and gold has gone from 25 to 40, maybe at the end of the year you can bring them back to 75-25, and that's how you can dynamically adjust. There can be more ways of switching in short term the allocations, but then those are extremely technical and involved ways of doing it, and it can't be suggested over this podcast. Subha has the next question. Buying SGB from secondary market and holding it to maturity will not attract any capital gains tax. So my understanding on this is that if you buy SGBs from secondary market, and if you are holding them for long term, from the long term point of view of capital gains, then you should not be paying any capital gains tax. Will RBI buy back from me if I buy from the secondary market? How will this process happen? So, for all sovereign gold bonds that have completed minimum 5 years from their issuance, at every 6 months, RBI offers to for you to surrender your SGBs and get your payment. And there is a process that you can go through with your DP. So I've done this few times. It is very simple. It's a form that your DP will provide you, and you have to fill in your mandate. And basically, it is very smooth after that. Uh, on redemption date, the SGBs will vanish from the demat account automatically. So how to redeem? So on redemption date, automatically the uh, sovereign gold bonds will be debited from your demat account, and RBI will automatically credit you the redemption amount as well as whatever is the interest for those 6 months directly to your bank account, which is linked to your demat account. So it is very, very clear. I have myself experienced it many times in the last 6, 7 years, all these different transactions, and there is really nothing to worry about. And there is a dedicated email at RBI. You can write to them, and they will respond in case you have any queries about SGBs. Haim Reddy says, given US stocks overran all the future potential, is it time to move the funds from US stocks to India and gold? That's a very difficult situation to difficult narrative to confirm that US stocks has ran over all future potential. Who knows? Maybe US markets will continue to go up. Maybe US will print so much money that market will double from here in the next 3 years. We really cannot say. So keep your allocations, keep your money in US stocks as well as India stocks as well as gold. I think that asset allocation will help you. But yes, I mean, if you want to take a tactical call that in case you think that US stocks have no further place to run, then yes, I mean, US stocks, India stocks, and gold is a good place to be at. Next one is from Ram Kumar. How often should we rebalance between asset classes? Is it time to book some profits in gold and invest in equity? So, again, depends upon person to person. I would recommend at least once a year, and you could look at maybe even twice a year if that it suits some portfolios where the volatility of the portfolio is higher. But in general, I would say once a year, uh, your allocation can change back to where you would like it to be. Neeraj says, just suppose India-Pak war escalated to a nuclear war. The market would obviously crash heavily. In such a scenario, is there a mitigation plan in place to handle the various weekend investing product investments? So, I think when and if the world goes nuclear, we will not have to worry about our portfolios. I think we'll have to worry about whether we will be alive or not. And if there is a nuclear war, I mean, there is no question about any stock market running or any depositories running. Everything gets demolished in that. From that point of view, it is that ultimate uh, black swan event. But I think the way the world behaves, and we've seen rogue states in war, just using the nuclear word as a threat, and because everybody likes their own life, right? I mean, whatever said and done, uh, unless you are a really a madman, you would not use such a tactic. So we have seen our neighbors are really mad folks, but even they have not been able to do anything on that front. So I think planning for that is impossible. Yes, there are some bunkers which are available in Switzerland, which they claim are nuclear proof. So any affluent person or family should buy space in those bunkers. They are very well equipped for food for years, and of course you will need a forewarning to go and sit there. But other than that, I think don't worry about weekend investing at all. I mean, if you're going nuclear, that's the last thing you want to be worried about. Divyansh says, thanks for your consistent commentary on market and gold. Just saw the In Gold We Trust report published today. Very positive about future gold projections. I've just started to read it, so I can't say that I've read it fully. Uh, can you also say on max drawdowns gold has experienced historically after long bull run, and about the probability of it reverting to mean, given that around 9% correction is done? Idea is to understand one who missed the rally should start considering or wait more. So my sense is that in Indian rupee terms, anywhere between 20 to 25% is sort of a very good drawdown phase to enter gold market. That is the sort of the larger drawdown. In a running bull market, you may get 5 to 10% drawdowns a lot of times, but in a major correction, you probably will get like 20 25%. Although in terms of historical, I think if you go as far as back as 50 years, we've seen one, I think, 40 or 45% correction as well. So that is because it is dependent both on the gold price and the currency price. It is difficult to say uh, where one should. But my sense is that gold should not be seen very tactically or in terms of a trade like situation. Continuously, buy gold like a sip, and you will not be worried about these, whether it is 9% or whether it is 12% and so on and so forth. I've been buying for the last 15 years, rather more, 2004, yeah, almost 20 years. And I bought at various prices from 4,000 rupees for 10 grams. Now it is 92,000 rupees at 10 grams. At various prices I bought it, it hasn't bothered me whether I'm buying 5% plus or 5% minus. So that's how I think one should look at. Ramesh says, I'm a subscriber of MI20. Wanted to ask during the current rally in defense stocks why they have not entered the momentum portfolios. I see only these two. So uh, MI20 has a very defined strategy, like all others actually, and there is no sort of overriding that strategy. So if in the mid and small cap space, which MI20 is catering to, if these two stocks are the only one that have come through from the defense side, that's why they are there. So uh, uh, I would say, all these entries and exits are happening basis a certain strategy and certain algorithm. So how and when these stocks will enter, because they also have history, right? I mean, it is not just because of last 2 weeks price. The strategy will also look at where they were a year back, where they were at different points in the last 1 year, and what has been the behavior. So all that will put through. But I think whichever stocks are there in this have been doing well in the last many weeks, and some others may also join very soon. Ramesh says, as per Mr. Shankar Sharma and his, I will not be able to comment on somebody else's theory because I have nothing to say about it. I don't know what that theory is, and but I've just read very recently that Mr. Sharma has become a contraindicator. Every time he says sell, market becomes a buy. So I've just read it. I have nothing to say, or I have no study on what he says. So I'm sorry on this. Hitesh says between MI20, MI Evergreen, and All Cap, please explain in terms of risk appetite and behavior in different market conditions to decide which product to buy. So, if I were to sort of put them in different buckets, then MI Evergreen is like large caps with gold. So, very nicely hedged with gold and only looking at the larger cap space with some larger mid caps also, the CNX 200 space. So more seen to be more like a safer and as the name suggests, evergreen sort of bet, not wanting to hit sixes like MI20 does sometimes. So MI20 is more mid and small caps where that punch of the small cap behavior should come through whenever we are trending very hard, and all cap is like a all weather, anytime kind of a situation, but with the advantage of going to cash when the market drops. That advantage also becomes a disadvantage when the market suddenly rises and you have to allocate gradually over a period of time. So if you are I would say risk averse, more risk averse. MI evergreen would be the situation. MI all cap probably will be in the middle, and MI20 will be in the higher risk category. But again, I really cannot advise risk to you. That is not as per my license. You will need to basically see the strategies and the risk profiling that is available on the platform and decide for yourself. But this is the general sort of situation that I've given you. Ram says, why have you stopped sharing momentum portfolio performances in daily bites and weekly videos? Because the regulator has stopped us from doing so. So, if you can petition to the regulator to allow us to share them publicly, we will certainly do that. Subha says, what is the difference between momentum investing and swing trading? So, typically, swing trading is not practiced like a portfolio. It's like an individual stock, and you are doing a very short term trade, probably on a hourly time frame, and potentially with a uh, span of, let's say, 1 to 7 days. That is the kind of span of a trade that you are taking, and you'll, as an individual investor, you'll take a few stocks and do swing trade on them and have risk parameters decided on each trade. Okay, I'm doing 3 trades on each one, I'm taking, let's say, 1% risk. So your position sizing will be according to that, and then you're trading that. In momentum investing, we are creating a basket of stocks with a, at least in our case in weekend investing, average hold of, let's say, 3 to 6 months. And this is riding a strategy which determines momentum ranking of the underlying stocks basis the last 3 months, 6 months, 1 year kind of price movements. And and hence swing trading is very focused, concentrated on short term, and momentum investing in general, although momentum investing has variants of all kinds, but in general it is much slower, and it is probably being done in a more portfolio like manner, with each uh, stock getting maybe like 2 to 5% exposure of the entire portfolio. So in swing trading, individual stock is in focus. In momentum investing, the entire portfolio as a whole is our focus. That as a group, we want to invest in stocks that are running away as a group, and some of these stocks will do really well, some may do as per the market, and some may not perform as well. But the idea remaining that the bulk of stocks that go into positive gain should have much larger wins versus the losing stocks. That is the whole sort of idea. So we have come to the end of this round. Please use Ask Weekend Investing hashtag in the comment section to ask your queries, and we'll take it up in the next episode. If you missed it this time, all the previous episodes are being put in the description. It's a good knowledge base to go through if you are interested in this kind of investing or market knowledge in general. So do go through that, and do like and share these videos. Do subscribe to the channel if you haven't so far, and do give us feedback what you would like to see on these videos. We are very open to getting your feedback and adjusting our content accordingly. Thank you. Bye.